Hello, in this video, I'll explain to you the closing entries. In fact, we will see how to journalize and to post the closing entries. At the end of the accounting period, the company makes the accounts ready for the next period. This is called closing the books. In closing the books, the company distinguishes between temporary and permanent accounts. The company closes all the temporary accounts at the end of the period. Temporary accounts are revenue, expenses, and owner's drawing. In contrast, permanent accounts relate to one or more future accounting periods. They consist of all balance sheet accounts, including the owner's capital account. Permanent accounts are not closed from period to period. Instead, the company carries forward the balances of permanent accounts into the next accounting period. Closing entries formally recognize in the general ledger the transfer of net income or net loss and owner's drawing to owner's capital. So closing entries are only made at the end of the annual accounting period and produce a zero balance in each temporary account. So this process, closing the books, consists of 4 steps. The first step we're having to close revenues to income summary. The second step we're having is to close expenses to income summary. And since income summary, it's also a temporary account that we created to close revenues and expenses, the third step is to close income summary to owner's capital. And finally, we're having the fourth step. It's to close owner's drawing to owner's capital. And as you know, owner's capital is a permanent account. Now, in order to see the closing entries and the different steps that we're having. So we're having here some numbers. The first step we do is to close revenue to income summary. And as you know, the normal balance of revenues, it's credit. So here we have to put it as debit. And the income summary, it's a credit since it's a double entry system. We move to the second step. The second step is to close the expenses. We know also that the normal balance of an expense, it's debit. So we have to set it as credit, and we have also to create the income summary. This is why we're having 7,740 debit in the income summary and all the expenses in the credit. Then we move to the third step, where we have to close the income summary. And as you see, the income summary, the first time we saw it, it was in the revenues when we were closing the revenues. And it was income summary credit, 10,600. And the second time we see income summary, it's when we were closing the expenses and also it was debit. So based on the T accounts that you can see it to the left, the balance of the income summary, it's 2,860 credit. So in order to close it, we have to set income summary debit 2,860. And the income summary, it's close to the owner's capital. Then we move to the fourth step. It's to close the owner's drawing to the owner's capital. And as you know, owner's drawing, the normal balance of owner's drawing, it's debit. So we have to set it as credit. Like this, it will be closed. So as you can see, this is graphically how the accounts were closed. We start from the first step where we closed the revenue, the second step where we closed the expenses, and then we were having the income summary, and also it was closed to the owner's capital, and also we're having the owner's drawings that it was closed to the owner's capital. Thank you for watching this video. For future updates, you can subscribe to the channel and hit the bell icon.